lesson, we'll discuss the application of momentum oscillators in determining trend and its oscillation. We'll discuss rate of change, that is ROC indicator, as an example of momentum indicators and how to employ it in identifying trend and their reversals. We'll discuss overbought and oversold levels, momentum oscillators in bull and bear markets, overbought and oversold crossovers, and momentum price divergence. We'll discuss the construction of the following very important momentum oscillators. These are relative strength indicator, stochastics, that is %K %D indicator, and trend deviation indicator, also called as price oscillator. Introduction to momentum oscillators. In this video, we'll introduce the concept of momentum and discuss the application of momentum oscillators. The concept of upside momentum is illustrated with the following example. When a ball is thrown into the air, it begins its trajectory at a very fast pace. It possesses a very strong momentum. The speed at which the ball rises gradually diminishes, and finally it comes to a temporary standstill. The force of gravity then causes it to reverse the course. This slowing down process is known as loss of upward momentum, is a phenomena that is also experienced in financial markets. The flight of the ball can be equated to a market price. The price rate of advance begins to slow down noticeably before the ultimate peak in the price is reached. On the other hand, if a ball is thrown in a room and it hits the ceiling while its momentum is still rising, the ball and the momentum will reverse at the same time. Unfortunately, momentum indicators in the marketplace are not dissimilar. This is because there are occasions on which momentum and price peak simultaneously, either because a ceiling of selling resistance is met or because buying power is temporarily exhausted. Under such conditions, the level of momentum is often as helpful as its direction in assessing the quality of a price trend. Thus, the use of momentum indicators can warn of latent strength or weaknesses in the indicator or price being monitored, often well ahead of the final turning point. The idea of a downward momentum can be well understood by comparing it to a car that is pushed over the top of a hill. The car begins to roll down the hill, and as the gradient of hill steepens to accelerate, at the bottom it reaches the maximum velocity. Although its speed then begins to decrease as it moves above and continues to travel, but finally it comes to a halt at the other height of the top. Market prices act in a similar fashion. The rate of decline or loss of momentum often slows ahead of the final loop. This is not always the case, however, since momentum and price sometimes, as at peaks, turn together as prices meet a major level of support or resistance. Nevertheless, momentum leads price often enough to warn of a potential trend reversal in the indicator or market average that is being monitored. Examples of important momentum indicators include rate of change ROC, the relative strength indicator RSI, moving average convergence divergence, and stochastic oscillators, among others. Price momentum can be computed using price data for an individual series, such as a currency, commodity, stock, or a market average, and manipulates it in a statistical form that is plotted as an oscillator. We call this price momentum. The principles or characteristics of momentum interpretation are the same for all the indicators, but some are specially constructed to bring out a particular characteristic. In this discussion, we'll start with ROC indicator and show the applications. Changing the oscillator may change some properties, but broad interpretations and contours of discussion remain the same. Momentum signals have some important properties. First and foremost, these momentum evidences act as supplementary witness in the overall weight of evidence approach with other indicators such as trend line, volume, among others. Often, momentum and sentiment are considered to be closely aligned. There are two major applications of momentum indicators. First, momentum indicators are often useful in identifying overbought and oversold conditions and price divergences. Also, momentum indicators can be used for identifying trend reversals. Assumption here is that if momentum is reversed, then prices will follow in some time. To summarize, in this video, we introduced the concept of momentum in the context of financial markets. We also discussed how it can be applied in identifying overbought, oversold conditions and identifying trend and trend reversals. In this video, we'll introduce rate of change ROC oscillator, which is one of the momentum indicators. For discussing momentum oscillation or properties of momentum, we'll use ROC as one case. There are multiple other oscillators. However, the discussion will remain similar. The simplest way of measuring momentum is to calculate the rate at which a security price changes over a given period of time. This is often known as rate of change or ROC indicator. If it is desired, for example, to construct an ROC using 10-week time span, then the current price is divided by the price 10 weeks ago. If the latest price is 100 and the price 10 weeks ago was 105, then ROC momentum indicator will or can be easily computed by dividing 100 from 105, which is equal to 95.2. The subsequent reading in the indicator will be calculated by dividing next week's price by the price 9 weeks ago. The result is a series that oscillates around a central reference point. The horizontal equilibrium line represents the level at which the price is unchanged from its 10-week reading ago. If an ROC calculation was made for a price that remained unchanged, the momentum index would be represented by a straight line. When an ROC indicator is above the reference line, some reference line, then the market price that it is measuring is higher than its level 10 weeks ago. If the ROC indicator is also rising, the difference between the current reading of the price and its level 10 weeks ago is growing. If an ROC indicator is above the central line but is declining, the price is still above its level 10 weeks ago, but the difference between the two readings is shrinking. When the ROC indicator is below its central line and falling, the price is below its level 10 weeks ago, and the difference between the two are growing. If the indicator is below its central line but rising, the price is still lower than its 10 weeks ago level, but its rate of decline is slowing. To summarize, a rising ROC indicator implies expanding velocity and a falling one implies a loss of momentum. Rising momentum should be interpreted as a bullish factor and declining momentum as a bearish one. Also, instead of using the exact 10 weeks ago value, we can use mean and median as well. Let's see this with an help of an example. Here we have weekly index price data is given. For each week, the index price value is given, starting from number 1, 2, 3, 4, 5 and 10. Now let's say if I want to compute the values for 10-week ROC, what I can do is I can simply divide the 10-week ago price by the latest price. So in this case, the latest price is 965, the price 10 weeks ago is 985. So we can divide 965 by 95 to get a value close to 98. Instead of dividing by 98, I can divide it by the median of previous 10-week values, which results in a value of 99.2, or I can use the mean of this, which results in 99.1. Similarly, as we roll on 1 week ahead, the value is 960 and the 10-week previous value is 980. Again, using similar procedure, we can either compute with simple 10-week ago old value, or we can use median or mean, and then we can keep on rolling over and over. This way we get 3 readings for simple, median and mean. These can be plotted here. For example, these can be plotted here. The figure suggests that broadly they indicate similar rising trend in ROC, whether we are using simple ROC based on mean or median. To summarize, in this video we discussed how to compute ROC, which is an important momentum oscillator. In this video we'll recap some of the important ROC characteristics. Please note, this horizontal line represents the level at which the price was 10 weeks ago. If the price is at, or the ROC is at this horizontal line, that means price is unchanged from its reading 10 weeks ago, if this is constructed for 10 weeks. If ROC indicator is above this reference line, then in that case the price that it is measuring is higher than its level 10 weeks ago. Please also note that ROC can be presented in two forms with percentage scaling, that means current price PT upon price 10 weeks before, or written form which is ln of PT upon PTW. So the bottom was in the written form, the upper one is in the scaling form. Also, if ROC indicator is rising like this, then the difference between the current reading of price PT and its 10 week ago level is also growing. So PT is moving ahead or growing as compared to its 10 week before level. If ROC indicator is above the central line and it is declining, the price is still above PT price currently is still above the price 10 week ago, but the difference between these two is shrinking. When ROC indicator is below this line and falling, the price is below its 10 week ago level, and the difference between two is growing because PT 10 week ago level is much greater than PT now. Also, if indicator is below its central line, here the price still lower than 10 week ago, but if the momentum indicator is rising, that means this gap is declining or rate of decline is slowing. In short, an ROC indicator implies expanding velocity. That means if ROC is rising, that velocity is increasing, like accelerating, and a falling ROC implies loss of momentum, sort of deceleration. Rising momentum should be interpreted as a bullish signal. So rising momentum is interpreted as a bullish signal, while a falling momentum or declining momentum is a bearish signal. Please note that analysis of any technical situation can be enhanced by the calculation of several momentum indicators, each based on a different time span. In this way, the trend line, price patterns, or divergences which may not be apparent in one period are more apparent in other. The discovery of signs of a trend reversal in several indicators constructed from different time spans add further fuel to the weight of evidence. Consider example of ETF price and 12-month MA as shown here. This ETF price and 12-month MA. MA is more smoother, the fluctuating one is the price, are plotted with three different period ROCs, that is 9-month, 12-month and 18-month here. ROC is provided here. Price and 12-month MA are plotted together. Note that the price trend line is violated. This price trend line is violated here. Almost simultaneously with the 12-month MA crossover. So there is 12-month MA crossover and trend line violation. So there is number of evidences. At the same time, all the three ROC also witness loss of momentum. So you find that there is a loss of momentum in all the three ROCs, and they cross zero line in some time. The equilibrium line is also crossed. So basically, trend line was violated. That is one evidence, and loss of momentum in all the ROCs is another indicator. So this is a good indicator or signal that now the price has lost its momentum and there may be reversal in the trend. Now momentum typically reverses along with price, often with a small lead, but just because oscillators change direction doesn't mean that price will also change. Price will also change the direction too, so that is not a guarantee. Normally a reversal in momentum trend act as a confirming evidence of a price trend reversal. So it's sort of confirming evidence in the weight of evidence approach. The final action or final signal will come from the price action itself. To summarize, in this video, we examined the relationship between ROC momentum oscillator and prices. We also saw how ROC is constructed with multiple time spans or different time spans can add value and fuel to the weight of evidence approach. Increasing momentum is a bullish sign while falling momentum is a bearish sign, and to be read in conjunction with actual price action or price trend. In this video, we'll discuss the two very important properties of momentum characteristics, that is overbought and oversold level. Perhaps the most widely used method of momentum interpretation is the evaluation of overbought and oversold levels. This concept can be compared to a person taking an unruly dog for a walk on a leash. The leash is continually being pulled from one side of the person to the other side as the dog struggles to get free. Despite all this activity, however, the dog can move no further away from the length of the leash. The same principle holds true for momentum indicators in the marketplace, except that the market's leash should be thought of as made of rubber so that it's possible for particularly strong or weak price trends to extend beyond the normal limits known as overbought and oversold levels, like these levels here. We can see that from one end at overbought to other end which is oversold. These areas are drawn on a chart at some distance above. The overbought is some distance above and the oversold is some distance below the equilibrium level, which is here as shown in the figure here. The actual boundaries will depend on the volatility of the price being monitored and the time period over which the momentum indicator has been constructed. For example, an ROC indicator that has a tendency to move to wider extremes over a long period than over a shorter one. It is highly unlikely that a price will move 10% over a 10-day period. Yet, over the course of a primary bull market extending over a 12-month period, a 25% increase would not be uncommon. Some indicators such as RSI and stochastics have been specially constructed to move within definite predetermined boundaries, as we'll discuss later. When price reaches an overbought or oversold extreme, the probabilities favor but no means guarantee a reversal. An overbought reading is a time to be thinking about selling, and an oversold one warns that the current technical position may warrant a purchase. In many cases, when a price reaches an overbought extreme, the news is good. Participants are optimistic and human nature tells us to buy. Unfortunately, the opposite is more likely to be the case. On the other hand, an unsold reading is usually associated with a negative news background. It is difficult to make a buy decision, but very often that is the most right and opportune time to make a buy decision. In view of the variability of indicators such as ROC, there is no hard and fast rule about where to draw the overbought and oversold lines. This can be determined only by studying the history and characteristics of the security being monitored. They should be drawn such that these oversold and overbought lines should be drawn such that they will act as pivotal points, which, when touched or slightly exceeded, are followed by a reversal in the oscillator. Unfortunately, when a particularly sharp price movement takes place, these boundaries will become totally ineffective. The market leash that we discussed earlier is made of rubber and can remain in overbought and oversold territory for long periods, like this. Consequently, it is essential to get confirmation from a reversal in the trend of the price itself or some other price patterns, price formation, trend line violations, and other signals before taking any drastic action. To summarize, in this video, we discussed the interpretation of overbought and oversold levels. Often, these overbought and oversold levels exhibit extreme conditions after which some kind of trend reversal is expected or due. However, the actual confirmation or actual action should be confirmed from price action and some other weight of evidences, for example, volume, trend line violation, and other signals as a weight of evidence approach. In this video, we'll discuss momentum or oscillator characteristics in primary bull and bear markets. The character of an oscillator alters according to the price environment. In a bull market, oscillators tend to move into an overbought condition very quickly and stay there for a long time. For example, here in the bull phase, the oscillator may remain at the top overbought level for a long time. In a bear market, it can and do remain in an oversold condition for a long time. For example, in a bear market, it may remain in the oversold level here for a long time. Please note the behavior of momentum indicator in a bull and bear market. This is a useful information itself, so we need to examine that, because if it is possible to draw parallel or horizontal lines like these against an oscillator, it provides very valuable information and clue as to whether the primary trend is a bullish or bearish, because depending upon bearish or bullish trend, the oscillator will hover around oversold or overbought level. Oscillators behave very different ways. Oscillators behave in a very different ways depending upon the direction of primary trend, whether it is a bull trend or bear trend. Another very important point here is that if you have an idea of the direction of the primary trend, whether it is bull or bear trend, you can anticipate what price action might follow from a specific overbought or oversold reading. In a bull market, price is extremely sensitive to an oversold condition. That means in a bull market, if price is at here oversold condition, you would expect it to rise very sharply or jump. If it is at oversold condition, price to rise or some kind of reversal to take place from here. In a bull market, the price is extremely sensitive to oversold condition. Similarly, in a bear market, like this, price is very sensitive to overbought condition. So if it is hovering around here or any touching at the overbought condition, you may expect short rewind to the downside. That means when you are lucky to see such kind of condition where price is overbought at bear market and oversold at bull market. If you're lucky to see this kind of situation, look around for some other confirming signals that the price is able to rally. An example might be the violation of downtrend line. The reason for this sensitivity lies in the fact that oversold condition in a bull market is very likely reflects an extreme in the short-term sentiment, and similarly for overbought condition in the bear market. In such scenarios, market participants are often focusing on the latest bad news and using that as an excuse to sell. Since this is a bull market, they would be better served by remembering the positive long-term fundamentals that will soon emerge and using this weakness as an opportunity to buy. The same happens in reverse during a bear market. Traders are focused on bad news, which sends the price down. Then some unexpectedly good news hits the wires and the prices rallies. The same thing happens in a reverse in a bear market. Traders are focused on bad news, which sends the prices down. Then some unexpectedly good news happens and it hits the wires and prices rallies. However, when it is fully digested, the news is fully digested, most people realize that things really haven't changed at all and the price declines again. Thus, the overbought reading is more often than not will correspond with the top of a bear market rally. Looking at it from other perspective, during a bull market, the price will be far less sensitive to a overbought condition. That means if it is a bull market like this, the price is moving like this, then the oscillator would rather hover around the overbought level. While if it is a bear market, the oscillator may hover around the oversold level lot of times. And the price, looking at from other perspective during a bull market, the price will be far less sensitive to an overbought condition. Often it will be followed by a small decline or even a trading range. At point like A, and vice versa condition may exist for point B in bear condition, bear run. Therefore, the rule in these scenarios is don't count on a short-term overbought condition to trigger a big decline because the odds do not favor it. In bull phase and vice versa situation in bear phase. An oversold level is a good buying signal in bull phase. In a bear market, though a market or stock is far less sensitive to an oversold reading, often failing to signal a rally or possibly being followed by a trading range, as we saw earlier at point B here. The maturity of the trend, whether primary or intermediate, often has an effect on the limits that an oscillator might reach. For example, when a bull market has just begun, there is a far greater tendency for it to move quickly into overbought territory and to remain at very high readings for a considerable period of time, and similarly for bear run in a vice versa manner. In such cases, the overbought readings tend to give premature warnings of declines during the early phases of the bull cycle. When the market possesses strong momentum, reactions to the oversold levels are much more responsive to price reversals, and such readings therefore offer more reliable signals. It is only when a bull trend is maturing or during bear phases that overbought levels can be relied upon to signal that a rally is shortly to be aborted. The very fact that an indicator is unable to remain at or even to achieve an overbought reading for a long, it's itself a signal that advance is losing momentum. The opposite is true for a bear trend. To summarize, in this video we discussed overbought and oversold characteristics. For example, we noted that it is normal for oscillator to remain at overbought levels when there is a bull run. However, during a bull run, if momentum is at oversold level, then it is a sign that there may be a rebound. Similarly, in a bear run, when prices are going down, the oscillator it is normal for oscillator to hover around oversold levels. However, if it is at overbought level, it may be extremely sensitive and a rebound may take place. However, the existence of such signals should not be taken as confirmation, but rather some other evidences such as trend line violation or price patterns may be used as confirmatory signals to take a trading action. In this video, we'll discuss overbought and oversold recrossovers and signal generation. In many cases, excellent buy and sell alerts are generated when the momentum indicator exceeds its extended overbought or oversold boundary and then recrosses back through the boundary on its way to zero. For example, this kind of crossover and then a reversal back towards the zero level. The figure shown here demonstrates this possibility. This approach filters a lot of premature buy and sell signals generated as the indicator just reaches its overextended boundary. But one should still wait for a trend reversal in the price itself before taking action. For example, price itself should also reverse. Here, it reaches the oversold level, crosses and recrosses back to zero. But after this recrossover, we can also see the price itself being reversing. There's a close connection between market sentiment indicators and the characteristics of oscillators. Since market sentiment differs widely during a bull and bear market, it follows that such variations are occasionally reflected in changing characteristics of momentum indicators as well, often referred to as mega overbought or mega oversold levels. A mega overbought like this is an initial thrust in a bull market following the final low. So there's a bear market following, there's a bear market, this is the bear market, and this is the final thrust in the bear market, and then this is the first initial thrust in the bull market, which is captured, and this mega overbought just captures this dynamics. This kind of mega overbought, it's a reading in the momentum indicator that it takes well beyond the normal overbought condition witnessed in the preceding bull or bear market. So this reading exceeds any preceding overbought level reading. It should be, for example, represent a multi-year high for the oscillator concerned, perhaps even a record overbought reading. Such conditions are usually a sign of very young and vibrant bull market that is starting. The very fact that an oscillator is able to rise, even rise to such a level, can be used with other evidence, for example, some kind of trend reversal or trend line violation evidence, to signal that a new bull run is begin. As we can see here, a new bull run is begin. This is the starting point as an overbought signal, mega overbought in fact, with the oscillator. It represents a sign that the balance between buyers and sellers has unequivocally shifted in favor of buyers. It's something like a person using all his strength to crash through a locked door. It takes a tremendous amount of energy to achieve. But once the door is finally shoved open, there's nothing to hold that person back any longer. In the same way, a mega overbought removes the prices from its bear market constraint, leaving it to experience new bull market. And vice versa for bear market or mega oversold also, which may be a first thrust in the bear market after a prolonged bull run. We can say that this mega overbought is the only instance when opening a long position from an overbought condition can be justified. Even so, it can only be rationalized by someone with a long-term time horizon. This is due to the fact that whenever an oscillator experiences a mega overbought, higher prices almost always follow after a short-term setback like this. So once there is a mega overbought, higher prices will follow. There is a short-term setback, but then prices will move up. This is due to the fact that whenever an oscillator experiences a mega overbought, higher prices almost always follow after a short-term setback or consolidation has taken place. In most instances, you will find probably that the correction has taken place following the mega overbought in a sideways rather than downward one. But there are just enough exceptions to cause the over-leveraged trader a lot of sleepless nights. Since a mega overbought is associated with the first rally in a bull market, it is a good idea to check and see if the volume is also expanding rapidly. If it takes the form of a record volume for that particular security, the signal is far louder because record volume coming after a major decline is typically a reliable signal of a new bull market. Expanding volume is more or less necessary condition since it is consistent with the idea that buyers now have the upper hand and the psychology has totally reversed. The same also appears in reverse for oversold extremes. So oversold condition appears like this. After a prolonged bull market, this is the first thrust in the bear market and there is a mega oversold. Consequently, when a price decline following a bull market high pushes a momentum indicator to its new extreme low, which is mega oversold, well beyond anything witnessed during the previous bull market or for many years prior to that. So this is extreme oversold, mega oversold as compared to anything observed in the history. The implication is that now sellers have the upper hand if it was a mega oversold. The fact that it is possible for the momentum indicator to fall so sharply and so deeply is in itself a sign that the character of the market has changed. When you see this type of action, you should at the very least question the bull market scenario. Look for telltale signs that all new bear market may be underway. What are the volume configurations on the subsequent rally? Does volume now trend lower as the price rises compared to previous rallies that were associated with trends of rising volume? and so forth. You can look for multiple evidences. Let's have a look at this figure here, shown here for spider technology. On the top we have price movement here, fluctuating prices, and bottom we have 10-day ROC. Notice that at this juncture there is a mega overbought level which is preceded by a long bear rally. So there is a bear market which is falling, and then there is a overbought. On the top in the price action we can see there is a very sharp price up move. Also some kind of trend line has been violated towards upside. So there are a number of signals which suggest that this mega overbought indeed indicates that some kind of bull run is about to take place, which is also confirmed by this inverse or reverse head and shoulder pattern, and also a trend line or neckline violation towards the upside. To summarize, in this video, we noted that overbought and oversold crossovers offer important signals. Often, following a prolonged bull or bear market, these overbought and oversold levels in fact are so extreme that they result in mega overbought or oversold levels. After a prolonged bear market, a mega overbought or vice versa, that is after a prolonged bull market, an oversold level indicates trend reversal, and once confirmed by some other signals such as price formation, price patterns, trend line violations, they should offer a very solid signals for trend reversal.